So we're starting with paper 1, or paper 2, May, June 2023, economics. Yeah, the first question. So which one of the following is a withdrawal from the circular flow of income? We have investment, consumption, savings, and export. Investment is not withdrawal, it is injection. Consumption is also what do I call it? Consumption is not a withdrawal, is an injection. Saving is a withdrawal. And export is injection, because money comes into the economy. Consumption brings money into the circular flow. Investment brings income into the circular flow. The only thing that does not bring income to the circular flow is savings, which is a withdrawal. So the answer is C, question 1. Question 2. Spain unemployment rate fell from 13.6% in quarter 1, 2022 to 12.5% in quarter 2, 2022. Its annual rate of inflation increased from 6.1% in January 2022 to 10.2% in June 2022. Which one of the following best illustrates the possible conflict between macroeconomic objective of a low rate of inflation and a low rate of unemployment? First, when we talk about rate of inflation is the percentage increase in the inflation rate within an economy. And macroeconomic objective are government objective to increase aggregate demand within the economy. So here, the conflict between here is about the short-run Phillips curve. And when we talk about Phillips curve, it talks about the conflict between inflation and unemployment. So the answer is A. Question 3. Which one of the following statement about classical long-run aggregate supply curve is correct? It is relatively elastic at high levels of spare capacity. That is Keynesian. It is not. It is perfectly inelastic at full employment level of real output. Yes, that's the answer. Then it is perfectly inelastic at high level of spare capacity. No, it's not. And D is not. So the answer for question 3 is B. Question 4. We have a chart here. So they said the chart shows changes in average house prices in New Zealand between January 2018 and December 2021. So the price of houses continue to rise over time. So now, they said which one of the following is most likely impact of the change in average house prices on existing homeowners between January 2018 and December 2021? High consumer confidence. Yes, there will be high consumer confidence. And why? The price continues to rise over time, and that will bring about a positive wealth effect. And a positive wealth effect will increase consumer confidence. Do you understand? So the answer is A. Negative wealth effect, no. Negative wealth effect will come if prices drops. An increase in net investment, no. A net investment is investment minus depreciation. We talked about that before. And low consumer expenditure, no. Because the price of houses are increasing, consumer confidence is high. So it is not D. So the answer is for question 4 is A. Question 5. In December 2021, the European Central Bank decided to end its asset purchase, which is quantitative easing. And when we talk about quantitative easing is a situation whereby governments, the central bank of a country buys financial assets of commercial bank in exchange for money. That is quantitative easing. So here they said in August 2022, the ECB started to sell these assets. If ECB starts selling its assets, it is not reflationary fiscal policy and deflationary fiscal policy, because fiscal policy is the use of taxation and government spending. So here we're talking about monetary policy. So it is not A or B, because A and B is about fiscal policy, which is taxation and government spending.
The central bank is all monetary.
Central bank is only about monetary policy. And reflationary, if it is reflationary, we use inflationary when it comes to recession. So it's not. And it's deflationary, which talks about reduction in price money. So the answer is D for question 5. Question 6. The table shows China nominal gross GDP and population for 2011 and 2021. When we talk about GDP and population, we're talking about GDP per capita. So it's not going to be A or B. So let's forget about that. Then we go to GDP per capita, which is GDP divided by total population. So they said GDP per capita in 2011 was 10,155. No. GDP per capita in 2021 was 12,557. Yes, because in 2020 it is 17,730 divided by 1.412, which gives us 12,557. So the answer is D for question 6. We go to question 7. Are you there?
Yes.
Between 2018 and 2021, the annual rate of unemployment in Pakistan increased from 4.1% to 6.5%. Explain one possible effect on the increase in the rate of unemployment on the public finance of Pakistan. So first, what is rate of unemployment? Rate of unemployment is the percentage of the workforce that is unemployed and are actively seeking for employment and willing to work. That is rate of unemployment. So, and for public finance simply means the amount of tax and public expenditure. So public finance implies to the tax revenue and public expenditure. Are you with me, please? It's okay. So an increase in the unemployment rate may increase unemployment benefits. And if unemployment benefit increases, it will in turn increase government expenditure. And if government expenditure increases, it deteriorates the public finance. I think it's clear. That's question 7. We go to question 8. There's a graph, I draw the graph already here. So they said between July 2021 and July 2022, there was a fall in business confidence in Germany. Draw an AD and LRAS diagram to show the likely impact of a fall in business confidence in Germany. So a fall in business confidence is likely to reduce investment, which will in turn reduce real output. As likely demand curve will shift leftward from AD1 to AD2. I have the graph here, and the longer aggregate demand curve, supply will stay the same, and the price level would fall from P1 to P2. I think it's clear.
So how do I know that I should draw this one instead of these two ones?
Yeah, because we're talking about consumer confidence falling, and it's about the aggregate demand. For long run aggregate supply, it's just going to be one.
Okay.
But aggregate demand is expected to fall because consumer confidence has fallen. Note, aggregate demand here is not about individual demand. It's about firms who are unable to invest further. Because if firms are investing, they only invest if they are able to buy. Or if they are not buying capital equipment or capital goods, aggregate demand is expected to fall. I think it's clear now. Okay. So go to question 9. In 2022, it was estimated that an increase in government spending of 25 billion in an economy would eventually result in an increase in the country's national income of $100 billion. That is multiplier anyway. Based on this information, calculate the marginal propensity to consume in this economy. So MPC, marginal propensity to consume, is change in consumption over change in income. And for the multiplier, it is 1 divided by 1 minus MPC. So here we have our multiplier. So an increase in government spending will bring about multiplier effect. So multiplier is 1 all over 1 minus MPC. So our multiplier is, MPC is 25 divided by 100. You get that? 25 divided by 100 because consumption is 25 and income is 100. So that gives us 1 over 4. And multiplier is 1 minus 1 over 4, which is 1 minus 1 MPC. 1 minus MPC. So that gives us 0.75. So our multiplier is 0.75 and our MPC is 1 over 4 or 0.25. Question 10, are you there? It said in 2022, Vietnam's output gap was forecast to be between -5 and -10. That's a negative output gap. And when we talk about negative output gap, it simply occurs when the actual GDP is less than the potential GDP. So explain one likely impact of a negative output gap on Vietnam's economy. A negative output gap could have the following impact on Vietnam GDP. 1, it may bring about unemployment, as this may arise based on the fact that there will be spare capacity within the economy. So if there's spare capacity, firms will be incurring more cost. And if they are incurring more cost, they wouldn't have any other choice than to reduce or lay off workers. That will bring about unemployment. Is it clear? Question 11. It said the chart shows the consumer price index to inflation rate in Rwanda between July 2021 and April 2022. This is a 1-year inflation rate calculated monthly. With reference to the chart, explain what is meant by deflation. We talk about deflation. Deflation is a persistent fall in the price level within an economy for goods and services. So Rwanda witnesses deflation between July 2021 and December 2021. No, July 2021 to December 2021. July 2021 to December 2021. That's when it mentions deflation. October, November, December, -2.0. From -1.1 and -2.0. Is it clear, please? Is it clear, please?
Yes.
Question 12.
Yeah.
We'll go to question 12. It said, define the term GDP growth rate. GDP growth rate is the increase in the total amount of goods and services produced in the country. An increase or decrease in the total value of goods and services produced in the country. That's the GDP growth rate. Not
Amount.
not the value of what is produced.
Yes.
A change in it, which is increase or decrease.
Okay.
Though we know GDP is the total output of an economy,
growth is
but growth is about a change in the output, a change in the GDP.
Mr. What did they say? Growth rate. What is growth rate?
Yeah, that's the extent to which the country or the economy is increasing or decreasing.
So
That's growth rate.
extent.
Yeah, that's the extent. Is it increasing or reducing?
Okay.
Do you get it? Okay. So that's 12A and B. With reference to figure 1, explain the difference between a balance of trade deficit and balance of trade surplus. We have the figure anyway, but let's just explain it here. When talking about balance of trade deficit, it simply means export is lesser than import. Okay, export is lesser than import. That's balance of trade deficit. And for balance of trade surplus, it occurs when the export of goods is greater than the import of goods. Import of goods. I think that point is clear. So that's 12B. So in December 2022, so we finish it up here. In December 2020, the BOT, that was balance of trade deficit of India, was 15.4 billion, while the balance of trade surplus was 0.8 billion based on the extracts in 2020. Clear. So go to question 12C. Analyze how an increase in the rate of inflation could have a negative impact on India's balance of trade. So let me go to extract and you read the question for me again. The extract.
Extract?
Yeah, for 12C. I want to go to the extract.
Line 9, right?
No, you read the question. I'm going to the extract.
Okay. Analyze how an
Hold on, please. Extract A, right?
Yes.
Okay.
Analyze how an increase in the rate of inflation could have a negative impact on India's balance of trade.
So based on the extract here, the rate of, first you have to define the rate of inflation. The rate of inflation is the annual percentage of increase in the general price level of goods and services in a given economy like India. So an increase in the rate of inflation will increase the price of export for India, which may in turn reduce the demand for India's export. And this can be confirmed through this extract. It's written here that it increases by 30%. 30%, yes, it's written there. And the trade deficit, the India recorded balance of trade deficit of 30 billion, which is here in the case study, as its imports exceed exports. So as an increase in rate of inflation may allow imports to be cheaper. So that's why import is cheaper. Yeah. That brings about trade deficit because import is done more than export. So I think that's the point about that.
6 months.
So are we done with that? Is that 12C, right?
Yes. Now
12C. Okay, great. So go to 12D.
Should I read?
No, I'm going back to the 12D again. Going back to 12D. Okay. Yeah, 12D. Examine. Okay, that's 12D. They said examine the likely impact on India's real output of its increased expenditure on imported oil. Extract A, line 7. So first you have to define real output. And what is real output? It can be defined as the price of a country's output adjusted with inflation or for inflation. Real output is a country's output adjusted for inflation. That is what real output is. Yes. So an increase in expenditure on imported oil is likely to reduce the aggregate demand of India. Yeah. So an aggregate demand is consumption plus investment plus government spending plus export minus import. So now import is increasing. If import is increasing, when you take this away, it reduces the aggregate demand. So an increase in importation will reduce the value of India's national income, which is the same as aggregate demand. So according to the extract, the value of import on Indian oil account is 30%. So however, the real output may not fall if India is able to increase its export on services, which according to the extract is increasing more than the import. Yeah. So if India is able to increase its export on services, which are rising faster than import of goods, that might actually improve the real output of India. Is it clear? Yes. So go to 12E. So with reference to the information provided and your own knowledge, discuss the likely effect of the increase in the base rate of interest in the Indian economy. First, what is base rate of interest? Base rate of interest is the price of borrowing or saving set by the central bank of a country, like India. So base rate of interest is a policy instrument, which is monetary policy. You get the math.
Wait, base interest is the total amount borrowed by banks, or should I just say
it's the interest is the price of borrowing or saving. Okay. Set by the central bank of the country. Okay. Set by the central bank of the country. So you could actually say base rate of interest is a policy instrument, which is monetary policy. So the Indian Central Bank raised the base rate of interest by 0.5% in June 2022. Is in the figure. So an increase in the base rate of interest may result into the following. One, it will result in an increase in saving, which may in turn reduce aggregate demand. People save more. If people continue to save, aggregate demand within the economy would fall because aggregate demand is the total saving within the economy.
Yes.
A fall in aggregate demand may bring about an increase in unemployment because if aggregate demand falls, unemployment is likely to rise.
Yeah.
So an increase in the base rate will increase the price of borrowing, which may in turn reduce investment done through borrowing as it is less profitable to invest.
Yeah.
So an increase in base rate will bring about a fall. With reference to the information provided and your knowledge about, so here we stopped at
4.
Yeah, 4. An increase in the base rate will increase the price of borrowing, which reduces investment done through borrowing as it will be less profitable to invest. If the interest rate increases, firms or businesses that borrow for investment will not be able to borrow because it will be more expensive to borrow. And if it is expensive to borrow, it means it is not profitable to borrow. So borrowing would reduce and investment would fall. You get that? An increase in interest rate may bring about a fall in importation. Because remember, spending, we don't only spend on domestic consumption, we also spend on importation.
Yeah.
If spending falls in domestically, it also affects spending in importation. So an increase in interest rate may bring about a fall in importation. This in turn improves the balance of payment current account of India. So India that is running on deficit might as well run on debt surplus or improve it because import reduces. And if import is reducing, the balance of payment current account will start improving. It might not get to surplus, but it will start improving. But if import increases, it will deteriorate the balance of payment current account. So this can be graphically represented as an increase in aggregate demand. So the aggregate demand curve is this. So a rightward shift in the aggregate demand curve from AD, a leftward shift, from AD1 to AD2, and the price level is expected to fall.
Yeah.
That's it. So go to question
13.
13. Thank you. So for question 13, we have to choose between 13 and 14, but we choose 13.
Supply side.
Supply side. So the question says,
You can give me some idea about 14?
Yeah, sure I can. So let me quickly talk about it before we go to question 13. There's many economists are expecting several of world's leading economies to enter recession. Evaluate the likely cause of recession on an economy of your choice. So here we could choose India, for example, or Libya, for example. First, what is recession? Recession is a fall in economic activity for consecutive quarters. So if there's recession, it simply means it's not just going to affect your country. Now, let's assume Libya has a trading partner in Turkey and Spain. Libya exports oil to Turkey and Spain. Global recession means trading countries with Libya would not be able to trade with Libya.
Yeah.
So how does this affect the economy of Libya? Libya depends solely on exporting oil.
Yeah.
But now the demand for oil reduces. Yeah. So it means revenue from oil to Libya would reduce. Yeah. So whatever Libya does in terms of its revenue, or whatever Libya uses oil revenue for would reduce. So then you can start talking about it one by one by one. And at the end of it all, it might allow Libya to start thinking about other ways to generate revenue. So you need to talk about recession, the impact of recession globally, the impact of recession to Libya as an economy, and the possible solution. But at the end of it all, you have to understand that there will be recovery. And recovery will come through increasing aggregate demand. And government will have to come up with this policy, like subsidy. Do you understand?
Yeah.
So now let's go to question 13. We have question 13. In 2022, Japan's productivity was approximately 30% lower than that of the US. Evaluate supply side policies that the government could use to increase the country's productivity. First, what is supply side policy? Supply side policy are policies that help to increase productivity, increase aggregate supply, increase competitiveness within the economy and output. So here, supply side policies are designed to increase output within the economy. With supply side policy, the long-run aggregate supply curve is expected to shift rightward. So supply side policy will increase the productivity of a given economy or country. And what is productivity? Output divided by the numbers of workers. You get the point there? Supply side policy will increase competition. How can supply side policy increase competition? This can be done through government privatizing some public enterprise that deem inefficient. Government will not just privatize. Privatization will come because of inefficiency of some of the public sector business. Do you understand? So you don't want to just say government will privatize. That's why I said supply side policy will increase competition. This can be done through government privatizing some public enterprises which are considered ineffective. Supply side policies such as spending on infrastructure may increase investment and FDI, which may in turn increase countries' GDP or output. You get that? Supply side policies such as cutting unemployment benefits, may bring about an incentive to work. This will increase the supply of labor in a given economy, which may in turn increase output. We talked about cutting unemployment benefit. So if unemployment benefit is cut, it simply means I have to start working. We don't just think about government is not giving us money as they used to give us. There's no social benefit. How do you make income? How do you consume? You have to start working. So that might increase supply of labor. And if supply of labor is increasing, then output will increase within the economy. Supply side policies such as cutting income tax may bring about an increase in let's use supply side policies such as cutting corporate tax. Corporate tax may bring about an increase in investment by firms, especially on research and development, which may in turn lead to innovation. And when there's innovation, that means we're talking about producing new goods or new products. New goods or services. I think the point is clear.
Yes, sir.
However, there may be negative consequences on supply side policies. For example, whatever you have mentioned in the past, you now start talking about the consequence of government using that policy. So the first one I talked about is privatization. If there's privatization, which is good, privatization might lead to private monopoly. And if there's private monopoly is what? Monopoly is a market structure whereby a firm is the only supplier of goods or services within the economy. So if government is encouraging privatization, privatization might lead to private monopoly. And if there's private monopoly, consumers becomes vulnerable. They exploit consumers. That's the consequence of privatization. 2, cutting welfare benefit. If government cuts welfare benefit, the welfare benefit might not be effective. Effective how? Cutting welfare benefit may not be effective if the unemployed are not willing to receive payment lower than the unemployment benefit. So government has cut unemployment benefit, but now we want to work. But when I want to work, I find out or figure out that what I want to get in terms of wage is below what I used to get as government benefit. So I won't want to work. So it's not effective. Do you get the point here? Then unemployment benefit. Then there's an opportunity cost. An opportunity cost might occur. Government may not be able to spend in other areas, strategic areas of the economy, because government is spending on increasing output. Maybe it's not about output now. Maybe there are other things government should spend on. Okay. So that's an opportunity cost. So government might not understand what it needs to spend on because there is information gap. Government is not economists. It's not they are not technocrats. They are not business people. So they might not understand what they need to spend on due to information failure or information gap, or asymmetric information. So that means government decision might not be. So there might be government failure as a result of that. Do you understand? Aside that, supply side policy like education and training might take time. Do you understand? Supply side policy like education and training might take longer period of time. You said that already. Yeah. So that can also affect, that means government might not be able to, the government of Japan might not be able to increase output initially.
What about if government borrow money to fund supply side policies to help the productivity in the country?
That would increase national debts in the short run. But in the long run, if it's spending on investment, in the long run, it will be beneficial. And the last thing we didn't talk about here, they said in 2022, Japan's productivity was approximately 30% lower than that of the US. So if Japan productivity has to increase, it means the government of Japan has to spend more than what the government of US has spent. So these are what you need to talk about supply side policy. And that ends paper 2 of 2023, May 2023, Economics AS. Thank you.